Great investor Donald Yachman, the longtime manager of the Yachman Fund, says his time horizon is 10 years. He likes growth companies at low prices and buys a stock when it sells for less than an investor would pay to buy the entire company. This investment philosophy has put the Yachman Fund in the top 1% among funds that invest in large cap value stocks for the past 3, 5, and 10 years. Over the past 10 years, the Yachman Fund has returned more than 13% a year. But his patient, contrarian investment style has had its critics. In the late 1990s, during the tech stock boom, the Yachman Fund lagged the market, and his board actually tried to oust him while investors fled. Then the dot-com bubble burst and vindicated his caution. Yachman topped the S&P 500 index by 34 points in 2002. In recognition of his stellar long-term performance, Don Yachman was a finalist for Morningstar's new Domestic Equity Fund Manager of the Decade award last year. According to Morningstar, Yachman has been a consistent and adept investor whose stock picks have put him head and shoulders above peers, not only in this decade, but throughout his 17-year tenure on the fund. We should also note that part of that tenure includes his son Stephen, who has co-managed both the flagship Yachman Fund and its younger Yachman Focus Fund since 2002. Well, unlike some other value funds, the Yachman Fund avoided big losses during the market downturn of 2008, besting the market and its peers by 11%. In a recent interview, I asked Don Yachman how he managed to do that.
I would say that it was a result of having a very small exposure in the financial area. We did have an investment in AmeriCredit. AmeriCredit is a subprime used car lender, which sounds horrible.
Sure does.
But it has a business model that really is a very profitable business model. And I can go into it in depth, but the bottom line is the information is readily available online and can be studied, and it's a simple company relative to, say, a New York bank that has, it's sort of like a black box. I mean, they're almost like the ultimate junk bond buyers because of the nature of them and the complication that they have. So we just don't like those kind of things. We feel like we're buying a business. We want to understand what we buy and want to have a comfort index, and we just didn't.
For our viewers who are not familiar with the Yachman funds, what's your investment philosophy?
The best way I can describe it is that we think of stocks as though they were bonds. And let me try to explain that and use a triangle in the process. The base of the triangle is a low purchase price. And what we do is we try to put a forward rate of return on a stock, looking at its cash generation power, its growth, its profitability, its reinvestment, so and taking into account inflation. So we come up with a compounded rate of return that one would have if they were to buy it and hold it indefinitely.
And that's your own metric. You're not taking that from any other agency or research analyst. That's your analysis of what this forward rate of return is for each company that you invest in.
Correct. And then by doing that, we just think it's easier to make a comparison objectively with other companies as well as with other parts of the capital structure, whether it be a bond, even a building for that matter. But then there can be quality ratings put on it. For instance, Coca-Cola may be a AAA, whereas, say, AmeriCredit is a BAA. And so there is a higher hurdle rate that would be required to buy the lower grade bond. And I can mentally picture all these yield curves with various grades on them, just like a bond buyer would, and buy it, in effect, try to buy the best risk-adjusted rate of return that's out there.
Using the bond analogy, going a little bit further in that, do you only buy investment grade stocks, or do you actually go into junk ever because it's, the reward might be greater at a certain price? Or
well, that's a great segue into the last couple of years, because in effect, if you go over let me use the last, say, 3 years as a cycle. The high grade companies stood out to us, say, in early 2008 as being the place to invest money. And we do this as bottom-up investors looking at them one at a time, but those were consistently where we were investing money. But by the end of 2008 and into early 2009, the spreads in effect opened up between the AAA and the, say, the BAA or below investment grade. And as my son Steve likes to refer to us as dumpster divers, at that point it really did pay to downgrade, so to speak, or to buy things that had more economic sensitivity or more risk, perceived risk to them, or were lower grade bonds, whichever way you tend to look at those things. And so that meant moving into things that had, in effect, enormous upside when the recovery came, and it benefited us dramatically.
Was it unusual for you to find yourself, in effect, trading into other names after the, or during the financial crisis of the last couple of years?
It's not our normal style, but I think what it really boils down to is being objective, and that's what we try to do. We try to be incredibly objective and think in terms of what will provide the best long-term rate of return for our investors. And so that's why we were driven toward those directions.
And at this particular juncture, after we've had a pretty good run in the stock market off the market lows of March in 2009, what's the value proposition out there? Are there still values out there that are attractive to you?
There are, but we're now kind of back in the same part of that cycle, so to speak, that we were back like 2-3 years ago, where it's the very high grade businesses that seem to be the best values. I mean, our biggest holding, for instance, is PepsiCo. And I think PepsiCo is a wonderful business, and I think it's at a good price. But most people are not going to be very revved and say, oh, how can you outperform the market owning PepsiCo? You know, well, on a risk-adjusted basis, to us it looks like really an excellent value. So,
you know, I'm looking at your top 5 holdings: PepsiCo, News Corp, Coca-Cola, ConocoPhillips, Viacom. Those are 5 very different names, but clearly they all have something in common. And is the quality factor what they have in common?
Yes, I think Conoco probably stands out as being somewhat different because it has a lot higher fixed asset component, where the others have low fixed asset components. And both Viacom and News Corp have more economic sensitivity, and Conoco to some degree does too. The other two really are just, I think, classic. Most people would consider them, I think, defensive stocks. But I think their valuations are very good. I mean, Coca-Cola, 12 years ago, Coke sold as high as $89 a share. Now it's in the low 50s. And people think, well, you know, it can't continue to do well because carbonated beverages aren't doing particularly well in the United States. 80% of the earnings come from outside the United States. And it's really an excellent value again.